I know exactly what you are thinking. I've seen all this before, right? Those educators and so-called gurus out there promise you the chance to become a gazillionaire with just a few dollars in your pocket with the big mansions and the fast cars. Well, I'll tell you this, we are different. I am different. I've been trading all my adult life since I left school. This strategy is different. We've back-tested this strategy over 16 years worth of data. Each and every daily candle has been back-tested and recorded. I'm going to talk to you about a really simple, easy to follow, reliable, profitable trading strategy that you can apply right after this video. Now, you can use this in the Forex market in particular. That's the way I've done all my work on it. But you can basically use it in any trading entity that you choose. I'm going to share with you the exact rules of entry, the exact exit rules, everything that you need to know. Now, before I jump onto the big screen to show you exactly how this strategy works and the backtesting results, let me tell you a little bit about how it was hatched. For those that don't know me, I started my trading career back in the trading pits in the city of London in the wild 80s. There we were, the young guns, literally throwing around millions of dollars on a daily basis, wearing our brightly coloured jackets, shouting and screaming. That's called open outcry. That's how we used to conduct our business. In fact, there's my coloured jacket back in the day. Still keep it for fond memories. But what I've tried to do now is replicate the trading style that we used to have in the trading pits here on the screens. What I found often in the pits was when the trend was starting to move, when the big moves were happening, the noise levels of the trading pits would break out into a massive crescendo. They would erupt as traders were scrambling to get in on the trend. But what I noticed is when the noise levels decreased in the trading pits and the noise levels would dissipate, that was the time that the trend was normally coming to an end. And normally when the trend comes to an end, the moves can be quite huge. So we've tried to replicate that here on the screens, and that's exactly what I've done with this trading strategy. Okay, so this is the equity curve over the 16 years worth of data that we have ran this strategy through. As I said, this was done manually by my team in our trading lab, going through each and every candle. This is a really healthy looking equity curve. And of course, you can change this. We tested this with a 0.75% risk. That's a 0.25% risk on each open trade. And we started off with just $1,000. You can see here, over this period, that $1,000 would have returned over $25,000. You can play with these numbers. You can make this here, up here, say $5,000. If you started with $5,000 on that, you'd have ended up with, looking like that, you'd have ended up with over 120 grand. If you'd have looked here to the left, I can show you the exact numbers of this strategy. It doesn't matter what numbers you put into the spreadsheet, the numbers here will be the same. Total number of trades over that period, 583. We had 461 winning trades. We had 122 losing trades. That gives you a win-loss ratio of 79%. A win percent of 79. The average win was 202 pips. The average loss was 129 pips. Always better to have more pips on the winning trades than you do on the losing trades. And your take profit ratio there was 1.57. If you don't know what that is, there's videos out there where I explain about all these different metrics. And basically the holding period was around 10 days. So you can see a very healthy looking equity curve. So now let's get straight into the actual trading strategy, the rules of engagement. Okay, so here is the naked day trading strategy. Now the clue is in the title. It's a day trading strategy, so it really does suit those that basically have day jobs and don't have much time to spend in front of the screen. It looks at the daily time frame, and it's called naked because basically we've removed all the technical indicators that you may see on the charts, all those lines, squiggly lines and so forth. That's all been stripped out. We're looking purely at price and support and resistance. Now, it is a reversal strategy. We're basically trying to replicate those conditions in the trading pits where the markets are going into trend, the noise was erupting, the noise would level off, then the markets would reverse and turn back on themselves. So it's basically a reversal strategy, and it relies on main levels of support and resistance. Just in case you don't know, support and resistance are horizontal lines on the chart that reflect change in human behavior. Typically, a support zone will be at the bottom of a downtrend. So here you can see the sellers are in control. Markets hit the same level twice, and that then confirms a support zone. Potentially, we'll see a move up in the markets. Here, the sellers are in control. Buyers come in and take the market up. So support is found where sellers are overpowered by the buyers. Resistance, on the other hand, is where the buyers are overpowered by the sellers. So markets are trending up, the buyers are in control, then they meet a wave of sellers, the sellers take control of that particular trading entity and push the price down. Again, levels that have been inspected more than twice would constitute a level of support, or indeed in this case resistance. Now, we don't just look at support and resistance, we use price action as well, and we use price action in the form of candlesticks. Now, for those that don't know anything about candlesticks, I'll give you a brief summary of what it is. There's 5 bits of information going on a candlestick. This tells you what's happening in a particular time period. Remember, we're talking about the daily time period, so this is going to reflect what's happening on a daily basis. Here we've got a blue candle. That basically means the market's opened here at that particular day. We traded to a low down here, hit a high up here on that particular day, but we closed above from where it opened. It's a blue candle, it's a bullish candle because it closed higher than where it opened. Here you've got a red candle. That basically means we opened up here, went to a high up here, then the sellers come in control, they take this market down, hit a low down here, and we close over there. It's a red candle, it's a bearish candle, means the sellers were in control of that time period. Now this tells us a lot about what's going on with human behavior, especially when you bunch them together. We're looking at specific candlestick patterns on this strategy. This is the bullish engulfer. So here you can see at the moment the red candle. Remember, the sellers are in control in this particular day, taking the market down. Then the following day, because it's a day trading strategy, we hit another low down here, but then the buyers come back in and reverse all the previous day's gains, and we close higher than where it opened and engulfing the previous candle. This shows you a potential reversal going on in that particular trading entity or forex pair. We're looking for these at support and resistance. Remember, that's the bullish engulfer. Same on the other side, you've got the bearish engulfer. Here you've got the buyers in control, you've got a blue candle taking the market up. The following day, the sellers come in, we have a bit of a new high, but then the sellers come in, completely overpowering the buyers from the previous day. We close back down here. It's a red candle because it's a bearish candle because it's a red candle. So we know the sellers are in control. This is a reversal pattern if you see this at the top of trends. I'll show you this more in a moment. And then another candlestick pattern I want to talk about are the bullish pin bars and the bearish pin bars. Let me tell you exactly what's going on here. It doesn't matter what color these are, by the way. The market's basically, on this example, we open here. Then the sellers are coming in, the sellers are taking over this market, and they push the market right down to create this low down here. But then before the day ends, the buyers come back in, push this market right back up, and we close up there as well. This is a pin bar. It's the main body. The difference between the close and the opening is in the top third, so it's a pin bar. And this shows you a big potential reversal. Shows you that the market's maybe wanting to change direction. And as I say, it doesn't matter so much about the color. Here you've opened up here and we've traded to a low down here. The sellers are in control. Then the buyers come back in and pushes right back up again, a bullish pattern. So if you see that in the bottom of a downtrend, that could show you that the buyers now are overpowering those sellers. More about that when I go on to the next slide. But there, the bearish pin bar, exactly the same, but in reverse. These are bearish patterns. You see these at the tops of trends. They could indeed constitute a big reversal. Remember, all relies on support and resistance. So basically, here is a resistance line. Remember, this is where the buyers are in control. We've hit this level twice. Yep, and then we see that pattern come in. That's the bearish engulfer at resistance, indicates a potential reversal. Very simple, yeah, very simple, very easy to understand. This is a sell bearish reversal pattern. This is another sell bearish reversal pattern. Here you've got the same line of resistance being respected twice. Markets are moving up. We hit a new high up here, but then the sellers come in. That's enough. Sellers take control, and we take the market lower. Close down there. That indicates a potential reversal in this trading entity, forex pair or what have you. So this is a sellish bearish reversal. On the other side of that, you've got the bullish reversal. So you've got a support line, levels that have been respected a couple of times. You put in this type of pattern, so we break lower, then the buyers come in, take control, push the market up. You see this level, you see this price action at a level of support, good indication this market is going to turn around, pretty much like it was in those trading pits back in the day. This is where basically the levels of noise is dissipating, markets may be changing direction. And we've got the bullish buy reversal using the pin bar. So a level of support, same levels being respected twice. You see that type of price action, breaks through the support, comes back, buyers now take control. This is a market that maybe wants to reverse on itself. But of course, there are rules to this strategy as well, and we'll go through those rules with you now. Okay, so these are the rules. First off, you need to confirm the support and resistance on the daily. It's also worth looking at the weekly chart as well. The weekly levels are very powerful levels because there's more players that make up a weekly candle, clearly. So confirm support and resistance. We've got special tricks of doing that as well. We'll learn more about that another time. Identify the bullish and bearish engulfers or those pin bars, those price patterns that I have just explained. When you see one of those, it's potential trade setup. So you enter the trade in two parts because we want to exit the trade in two parts. And we normally enter 3, maybe 5 pips above or below that pattern, those patterns I have just explained to you. But of course, with all trading, when you enter a trade, you need to make sure that you've established your maximum risk before you take that trade. You've got to lock in the risk. That's how you can position size and so forth as well. So as I say, we have 2 profit targets. So you need to set your profit targets at the next levels of support or resistance, depending, of course, on whether you are buying or selling. Remember, we're exiting in 2 parts, so you need to set your 2 profit targets. But of course, when you're setting up a trade, you always need to know the maximum risk that you're going to expose yourself to on a particular trade. And in order to do that, you need to have a stop loss. And we set our stop loss 3 to 5 pips, again, the other side of that price pattern that made you enter the trade in the first place. So we have our stop loss, we've established our risk, we've used our correct position sizing as well. I can't go into all that on this, but basically you need to make sure you've got your risk set out before you take the trade. Now, if take profit target 1 is hit, that's the next level of support or resistance, then you move the stop to break even on the second part of the trade, the second trade. So basically you're in what they call a risk-free trade on the second part of the trade. Okay, so let's just talk about the risk rules when setting up a trade. This is very important. I say here you should never risk more than 1% per trade. Actually, I would recommend you maybe trade less than 1%, maybe 0.5%, 0.75. I know a lot of successful traders that are only risking 0.25% on each and every trade. The idea is you don't want to make one trade make you or break you. You need to use compound interest, grow the account over time. That one trade is not the maker or breaker. Now, when you set your trade up, you need to make sure that your first profit target is at least half the distance of your stop. Now, you may have learned in the past that you should always have a positive risk reward. Well, yes, we do have a positive risk reward, but on the first trade, because remember we moved to break even, once that's been hit, you need to make sure that it's at least half the distance of the stop. This is how we back tested it over the 16 years worth of data. This is what we trade live each and every day. This is how we trade it. So make sure the risk reward is at least 0.5 of the stop that you have placed. Right, now I'm just going to jump onto the screens and I'll show you some worked examples on the backtesting software. Come on. Okay, so here we are on some backtesting software. Now I'm using Forex Tester 4. Please be advised, I don't work for Forex Tester 4. I'm not an official promoter of Forex Tester 4 in any way, shape or form. I don't get paid for this, but it is a piece of backtesting software that we like to use. But there are others out there. So what we're seeing here is an uptrend, and I'm looking for my engulfing patterns or pin bars at the top of this trend. I'm just going to scroll through by clicking my space bar. And there you see we have a bearish engulfer at the top of this trend where we have a resistance line. So the entry is 3 pips below the candle pattern and the stop is 3 pips above. Profit targets are going to be at the next support zones, and off we go. Okay, we're in the trade. Take profit target 1 is hit. Stops to break even. Off we go again. Almost hit profit target there. And eventually take profit target 2 is hit. Okay, so you can see here we are in a downtrend. We have a bullish pin bar at support and off we go. So we're in the trade.
Take profit target 1 is hit. Stop to break even. Take profit target 2 hit. Almost 400 pips on that trade alone. Now, of course, I'm cherry picking winning trades for the sake of this presentation. Not all trades will be winners. We will have losing trades as we go. That's why we do this back testing. We do the back testing to get a big picture over a large sample of trades. And that's how you get your confidence when trading a strategy. And the other beautiful thing about trading with something like Forex Tester is it does all the statistical work for you. So you can see here all the metrics, the average win, the average loss, profitable trades, losing trades, and so forth. Here we can see a solid downtrend. And there we have a bullish engulfer. This is a trading opportunity. If we're at support, enter the trade for 2 exits and stop below the candle pattern. And off we go. We're in the trade. Big move to TP1. Stops to break even. And TP2 hit. And TP2 hit not too long after. Another 300 pips there. Now, of course, that's just 3 trades I've shown you there. My YouTube director has told me to keep this down to just a few minutes. But I've got extensive video work done showing this backtesting in much more detail. And I'm happy to share that with you.
Okay, so I hope you found that useful. Now, if you want to start making these returns for yourself, just click the link in the description tab below to get 4 in-depth trading strategy videos sent directly to your email inbox. It's completely free, no payment details required at all. Now, in the series, I'll teach you everything that you need to know about the naked trading strategy. That's going to be hours of detailed trading strategy videos, and it's completely free. If you want to see me and the other professional Forex mentors trade this naked strategy each and every day, sign up for the 7-day free trial and come and join us here at Forex Signals inside the trading room. You've simply got nothing to lose. As always, I hope you liked the video. Don't forget to subscribe to the channel if you don't already do so. Happy trading and see you next week.